You are watching Huskin's Forex and Financial Market Brief. For a low-cost trial to premium Forex coaching, click on the link below.
Hello, this is Huskins, your Forex mentor. Welcome to the daily review of May the 8th and the preview of May 9th. It's going to be an awesome presentation today. I'm going to talk about a live trade which is happening right now. I'm going to be talking about my gold views. I have an entry order on my gold, so it's going to be interesting. Sit tight and let's see. All right, so we had three trades today. We finished one. We are I've placed my orders for the second one, which I'm going to be looking at, and the third one was going to come out in a little bit. For the only trade which is already over and done with, the CPI out of Switzerland at 3:15 a.m. It was awesome 30 pip winner. We had the most it would have been against you at any point in time would have been about 12 to 14 pips. Did not come close to your stop, and then it went on to hit our profit target. Now, I'd like to share with you the New Zealand employment trade, which is going on right now. Okay, so this is a live chart of the New Zealand trade, and basically the trade plan says that I want to buy the New Zealand dollar. But the master trade plan, which talks about the average true range, tells you where do you want to buy it from and where your target is. So let me do a quick summary of what I talk about. The average true range for the New Zealand US dollar pair is about 90 pips. So on an average day, this pair moves 90 pips. And now, if I expect this particular instance to be the low of the day, all right, if I expect this particular instance to be the low of the day, plus 90 pips from there, put us close to about 0.498. So now, if I'm going to be targeting 0.0498, my signal is to buy the New Zealand dollar. The place from where I'm looking to buy the New Zealand US dollar is after it retraces a little bit, and I'd be comfortable buying it from the 0.8428 level. So that's where if the market comes down and takes me in, I'll be buying it, and then I'll be targeting the 8498-ish level. Now, it depends on your own thoughts. If you want to use this trade plan analysis, but you believe that you want a bigger stop, where would you place it? Now, I'm placing my stop below these the news candle low. But let us say that you wanted to place your stop below these lows, and you expect this to be the 24-hour low. You'd want to place a stop below these lows. Similarly, from these lows, you'd want to add 90 pips. So 8379, so 8469 is where your target will be. All right, so you want it to come down between at least half of this particular level. So what does that mean? You draw. I like to use the Fibonacci to give me a quick idea of what is half. So here we go, around the same level as my entry. But now your take profit will be, it would be a lot closer, and your stop loss would be a lot further, because it will be a 1:1 risk reward. What I'm going to be trying for my particular trade is a 1:1.5 risk reward. So I will keep you all updated on how this particular trade finishes. We do not know whether we'd have a trade or not. In the sense that we'll have an entry or not, and I will let you know how it progresses. Now, the Treasury auction results. Let's look at the Treasuries. Here we go. This is the public debt news. So this is the official website of the United States Treasury, and let us look at what is it that I'm interested in. I'm interested in the yield. The highest yield, that means the lowest bond price, was at a yield of 1.810, and the lowest yield was 1.699%. So basically, in all, if you loan money to the US government, they're going to give you an interest rate of 1.699%. That's the lowest, and the highest it was 1.810. Now, you need to also bear in mind that the Fed is artificially increasing the price of bonds by buying bonds, so that the yields are as narrow as they appear, and people do not want to invest in the bond market because it does not pay them much money, and they gravitate their money to the stock market, which means that the stock market gets inflated. So and that's exactly what we are seeing right now. We're seeing the stock markets reach and break new highs, and we know that this is because of the Fed's policies. It's not sustainable, because if the stock market were making new highs on new earnings and on the performance of the companies, that is what I call sustainable. If it is making new highs on just the money, money can be pulled out at any time, and it's not reflective of the true valuation of the stock. So that's something which I wanted to share with you. Now let's look at visiting gold, and I'm going to be placing a limit buy order on my gold trade. Now it's going to be really far away, but I'll give you my logic behind that. And the sooner we when we start seeing better and better fundamentals for gold, I will make my limit order go higher and higher. Let me share this with you. All right, so this is the chart of gold, and we can see it is currently at 1472. Remember that big drop we had? It took 1 day to drop so much, and it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 days to come. It's not even closed above it right now. Not even once did it actually close above this. So, well, basically, what does this tell us? That gold is still in a downtrend, and we could have the effect is that there could be another run on gold, run to the downside. So basically, I'm expecting the price of gold to fall. This is not backed by the fundamentals, just like the rise in the stock markets are not backed by fundamentals. The fall in the price of gold is not backed by fundamentals. So that is the reason why I feel that gold is both currently overpriced and underpriced. Fundamentally speaking, it is underpriced. and technically speaking, it is overpriced. So what I'm going to be doing is I'm going to be placing my order to go long from gold at 1,218. That's where my order is. That in case we have another super rundown on the price of gold, that's where I expect gold to finally lose all its speculative traders and fundamentals to take home from there, and I'll hold it. I'd hold it forever. I'd hold it maybe till the prices hit 2,000 or maybe even $3,000-4,000. But my exit is not yet. I haven't yet analyzed my exit, but I do know that I'm going to be entering at the 1,220-ish mark in case gold goes there. Do I expect it to go there? No. In the sense that fundamentally I speak, I've given my views on the Chinese granny effect, the fundamental price of gold. So I don't expect it to go there. But if it goes there, I'll be buying from there. Another thing is that eventually, when I see more and more fundamentals creep into the market, even if the price does not come down, even if it remains zero, even if it starts going up without coming down, if I see more and more assertions that the leg down in gold is over, I'd then go ahead and share my entry of my gold price. So I might then keep on putting my gold price upwards and upwards and upwards and upwards till it is till I get filled. But right now, this is where we stand. Now, is the Chinese 8.16 billion trade surplus real? Now, China recently had, announced its trade surplus of 18.16 billion in April. This figure was considerably above the analysts' 15.1 billion, which the analysts were actually expecting. Now, is this the trade surplus? First of all, let me try and explain to you what a trade surplus is and what a capital surplus is. They're very confusing for a person who does not understand economics. So let me try my best. Basically, if China sells goods and services to the rest of the world like it does, people will it will have a trade surplus. And now, to balance that, if it'll have so much of money, and to balance that, and keep its currency from falling, keep its currency from rising, what China would have to do is have a capital account deficit. What do you mean by capital account deficit? That means it will take the money which it got from the foreigners and it will have to invest that money into foreign places. So that's exactly why China goes ahead and buys the US Treasury, because it needs to do something with the dollars. If it does nothing with the dollars, the price of the yuan will have to appreciate, and then it will not be such a export powerhouse. So now, what China has in fact done is that it has a fully convertible trade trade account with the rest of the world. That means if I want to buy yuan, to basically trade and exchange it with my Canadian dollar or with my US dollar, China welcomes that. But if I want to invest in China, China does not allow that. It is not completely convertible. That means a person, an outside nation, cannot invest in China all that easily. I'm talking about it from the currency aspect of it. So what a lot of firms are currently doing is that they are exaggerating the exports and bringing in funds which are actually disguised as trade payments to circumvent China's restriction on inbound capital flows. So if I want to start a new factory in China, I cannot very easily send my US dollars to China. But if a current factory is existing in China, and they buy or they sell me goods and services, I can inflate that amount and then send it to them as a trade, so that those companies have excess of money, and now that the money is already in China, they would be able to go ahead and buy the factory. So that's something which you need to look out for, and the way this thing plays out will be very important in our view of where the currency markets are headed. So let's preview the rest of the trades. We have the Australian employment change, which will be coming out. Then again, we have another holiday in Germany, Switzerland. So I'm kind of sort of I'd want to stay at the side. That's why I have these yellows. I'm not going to be trading them, but in case you make your own judgment call for your own account. So that's about it. I might want to trade the US initial jobless claims that will be out tomorrow. I might want to do that because that's looking at the US market, but the UK's cash rate, I'm going to pass on that. Of course, I'll be looking at trading the Australian employment change, and we already have our orders set for our New Zealand employment. Let me pull that up. See, we're not yet filled. I'm expecting it to come down, fill me in, go back up, and hit the target. This is my target. All right then, have a wonderful day. God bless. Bye for now.